Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, April the 3rd, 2025, recording this in the morning. So obviously, I guess everyone's been looking at the tariff news. Generally speaking, I suppose what we can say, to keep it simple, is that at first sight, much more aggressive than expected. Some people talking about, 10, 15%, sort of universal tariffs with a lot of nuance, et cetera, et cetera. And I'm just looking back at my notes from yesterday, sort of focus on reciprocity, openness to negotiate, avoid treating VAT or sales tax as a tariff. Trump essentially ignored all of those and went for a very sort of strong level of tariffs. I mean, I'm just looking at a bunch of research, and everyone seems to be saying that overall hit, it was sort of on a weighted basis, maybe 20, 22% across the board. Obviously, some countries a lot more. But basically, let's have a look here. So Asia seems to have been a big loser here, specifically a relatively large economy in terms of exports, like Vietnam getting up towards 45% tariffs here. You also see like Sri Lanka and Bangladesh, who make a lot of sort of clothes and things like that. So the point is, and it's interesting if you look at something how the market's reacting. I mean, we can take, for example, something like Nike. Just bring that up here. Sorry, guys. So we'll just bring up Nike uh, stocks. And I'll just put that. You could see in the pre-market, where are they? Let's have a look if they're even, if the pre-market. Look at that. I mean, this is a 5-minute chart here. So you see here Nike down from $65 down to 58. So taking a pretty big hit there. And anyone who's basically going to be importing a lot of stuff from Asia, sort of clothes manufacturers, companies like Nike are going to be under a lot of pressure. So just getting back to let's just see who didn't do very well here, and we can just look, as I say, Asia did pretty well. I just want to go back to this kind of countrywide thing which I've got on here. So we can see here that, for example, Australia only 10%. What was interesting is that Mexico and Canada were actually not on the list. Trump had this big board and was not actually on the list. They still have some tariffs from the previous tariffs, but nothing extra. So on a relative basis, sort of Mexico and Canada sort of got off, so to speak, got off quite relatively lightly. So Australia also 10%, and also the UK 10%. So I think at this stage, looking at some of these countries here, Australia, Turkey, these in the 10% on a relative basis. Brazil as well doing relatively well on a relative basis. Keep in mind these are new tariffs. But a lot of the sort of Asian countries, and of course the big one here is China. And it was announced at 34%, which was quite shocking. But that's on top of the 20% already imposed on a lot of products. So we're talking in China maybe 50, 54% of tariffs. And really what's going to be kind of interesting here if we start looking around at a few markets. So let's just start looking at the market reaction. And maybe what we can do, I just want to actually start looking at the currencies. And so let's look at the Chinese renminbi here. So I'm going to go on the offshore one. And there's been a level of support for the Chinese renminbi by the Communist Party of about 7.4, which you can see has gone back a long time and hasn't really been broached a triple top. And of course, we got up towards that and just sort of selling off a little bit this morning. But really, the key question here is, will China devalue its renminbi, its own currency here, just to sort of try and offset some of those tariffs. So going to be kind of interesting. I just saw a headline passing saying that China regards the tariff imposition as bullying, as unfair, a lot of negative comments, no specific reaction yet. We'll see. But something they can do is just to let the renminbi weaken up, into the 7.5, maybe even 8 kind of level, something like this. Just let it weaken and try and offset some of those. The problem for China is that they want the renminbi to be potentially a replacement or a competitor for the US dollar in terms of the global sort of reserve currency. And if they make it too sort of volatile and too sort of weak, that's going to sort of undermine confidence. So it's a little bit of a conundrum for the Chinese Communist Party here, we'll see. But probably, to be honest, the pressure should be sort of for a weakening renminbi against the US dollar. Having said that, the US dollar, as you can see, had a big sell-off. This is the dollar index. So we need to show a bit more nuance here. And really the way the market is interpreting this is simply to say that this, who knows, maybe 12, 18, 24 months could be a positive in terms of sort of, sort of companies coming back to the US and opening factories, manufacturing plants and manufacturing jobs and whatnot. But just in the short term, the market's reaction is clearly signaling that the market thinks this is a big negative for US growth and a negative for global growth. So there's a lot of pressure on US denominated assets this morning. And so what we're seeing here is the US dollar weakening. And what is going to be interesting as well, though, is at what point will the US come in as a sort of a safe haven with the sort of the dollar smile theory? But maybe that's got another few more days to go of selling. So we see here, let's just look around some of the assets. Euro up enormously, over 2%. So the euro now just getting back up towards that range where it had been trading up towards 111, 112. So the euro doing very, very well. But you've got to also say, is that possible to break out further? Just because, again, we're going to see some, tariff retaliations probably from the EU being announced, in the next 24, 48 hours. This cannot be great for European sort of stocks or growth. So the thing is, I think the upside of the euro is capped. I don't see this sort of ripping towards 120 or something. I think it may face a little bit of a sort of upward sort of overhead resistance at about 112 or so. So the euro doing very well. If we look at the Australian dollar doing okay, but the reality is that Australia, even though Australia itself only was imposed with 10% tariffs, which in the scheme of things is a relative winner, quote unquote. So the Aussie dollar doing a little bit better. But the reality is that Australia is extremely exposed to China. And if there's pressure on China, that is not going to be good at the margin for Australia. So we can also see New Zealand here doing quite well. So again, the commodity currencies outperforming at the US at the moment. Also see a USD CAD down a lot. Again, as I said, CAD was not on the list. Canada was not on the list. We've seen this morning, for example, Canadian Western Select Oil outperforming WTI. So this, because the oil sort of imports from Canada into the US were excluded. So overall, the market sort of quite liking what it's seeing in terms of Canada. And that's reflected a bit as well if we look at the Mexican peso, which also was not on the list. So we see the peso attempting sort of to push higher a little bit. But again, it's going to be interesting. Countries like Canada, Australia, and Mexico, and the UK. If we look at the pound, for example, just have a quick look at the futures here on the pound, you see the pound ripping higher. So all of these countries, perceived to be sort of winners in a short-term sense. But as I say, once the dust settles and sort of reciprocal tariffs are imposed, and do we indeed get a global hit to the global economy? It's going to be interesting to see if these currency gains can be sustained. And of course, the one thing which also did very well against the US dollar is the yen that seems to be taking the safe haven flows. And in terms of Japan being hit by the tariffs, if we just look at the level here, Japan here we see got about sort of 20-25% here. So Japan also going to be under pressure. So safe haven for the moment for the Japanese yen. But again, we're going to have to see just how much further that can fall. Just interesting, just on a side point here, you see also the Swiss franc doing pretty well. So all in all, very, very broad US dollar weakness. Weakness also, let's have a look at some of these commodities. We see that oil really being hammered here. Actually, where's oil? Let me just bring up oil. So oil down almost 6%, so about $4.50 here, just a huge red candle. And you see that oil, as I was saying, had broken out. I mean, I guess that bear flag did turn into a bear flag finally. Better late than never. But oil here, again, I don't want to read too much into it. Technically, there's a 38% fib retracement, but really oil being hammered here just on the idea of global growth diminishing, sort of being reduced. So very simply, if global economy is slowing down, this is not good for oil. Now you combine that with the sort of the delicate supply and demand sort of balance. And we just had news literally a few minutes ago from OPEC Plus that they're planning to increase their barrels per day production of 411,000 barrels per day. So this is not a huge amount, but basically by 2026, they're planning gradually to ramp up production. So to increase output up to about 2.2 million barrels per day by 2026. So the point is here is that OPEC Plus, just at this moment when it looks as though global demand could be taking a hit, they've decided just to very slowly ramp up production. And those two factors combined is not good for oil. So you've got to say at this point, again, just on a technical perspective here, you've got sort of some lows here. You've got a long-term trend line here. At a minimum, I think oil would most probably, I imagine, the WTI want to test down to about $65 here, maybe even run some stops. At that point, it could be interesting. But oil definitely under quite a lot of pressure here. Exactly the same thing here you see with Brent. If we look at gasoline as well, or down. So the energies stocks down here. Actually, I haven't looked at nat gas. Let's have a look. Nat gas not particularly reacting too much, but oil down a lot. If we look also at the equities, well, first of all, VIX. So we look at the volatility. So let's actually just have a look at the VIX as sort of a curve. It's going to be quite interesting here. So just let me bring it up, guys. G vol for volatility. Let's look at the futures curve. So presumably this is in a sort of a forward kind of backwardation. So as you see, trading as we speak at about 26.5, so very high vol. And if we put that compared to even like a day ago, that should show some, yeah. So you see even like a day ago, it was still, the curve itself was relatively flat, but you see now a pretty strong sort of backwardation here. So that's signaling a lot of risk. You see the first futures contract here now in a backwardated state against the rest of the curve. So, you know, for sure, very strong vol. And again, just to do the maths on that, if we have a 26%, 26.5 sort of vol divided by 16, our implied average move today on the S&P is about 1.65%. That would just be normal sort of volatility. So just getting back to the market reaction, obviously all the equities down, but specifically the US equities really being hammered here. I mean, I guess we've all had a look at that. Looks like the 5,500 is sort of the line in the sand just for the moment, but equities down, you know, 2, 3, 4% here. NASDAQ, same thing. You don't even have to look at that. Russell, everything down a lot. Actually, if you see the Russell here down 4.7%, so the Russell, the small caps underperforming, and no doubt the equal weight RSP will be down today. So a lot of damage being done here. Now, the question here, if you look at a measured move, so you look at this red, if you look at this Fibonacci extension, just from a technicals, 5,500 is a pretty important level. We had a tiny little bounce. I wouldn't even call it a bounce, but, you know, but let's say, for example, we bounce up to 56.68, something like that, or even up to 58.80, which I doubt. I doubt very much. But if you were lucky enough to get that, that would be an interesting shorting opportunity, maybe some kind of long put spread. I'm looking myself at the 55 to the 5,200 here. If we get, you know, a slightly more attractive entry level. But what is interesting here, if that, as I said, if you look at, let's say, Fibonacci extension drawing this one, so sort of an A, B, C, D kind of situation here, that does measure down the Fibonacci extensions down to about 5,200 or so, which also coincides with some of these levels. So the point is here that you know, we have had some damage, but if you put it in a longer term perspective, equities still could come down a lot. This is not at all, you know, a crazy sell-off. At this point, since the highest, we've had 10%. You know, a lot of, you know, nasty sell-offs, you know, historically been down like a 20 or even down to sort of a 30% or so. So let's see what happens. But basically, equities are down. Global equity also down. Let's have a look here. So we look at Euro stocks, as you guys can see here, down quite a lot. We're also looking at the German one, not quite as affected. Again, there's already sort of talk coming out of Germany of even more fiscal stimulus. So that's going to be interesting to see if the Europeans, because one way of reacting to this is simply, instead of putting on reciprocal tariffs, which ultimately could result in a damaging kind of war situation, trade war kind of situation, is simply just to have more fiscal stimulus. And already we're hearing from the Europeans, you know, potentially about rescue packages, fiscal stimulus kind of packages. Maybe China will come in with the same kind of thing. So it's going to be interesting that maybe actually the rest of the world will try and sort of stimulate, and this, you know, stimulate its way out of this sort of you know, sort of declaration of tariff war by Trump. So it could still be that, you know, sort of US assets underperform rest of the world assets. Just looking at a couple of other indices here, we've got the Nikkei, you know, continues to trade very, very heavy. If we look at the Brazilian market, now remember Brazil only got about 10% tariffs, so Brazilian market not doing too badly. But I'm definitely going to be watching EEM this morning. So that's the emerging markets ETF, down to 43.09 in pre-market here. I think they're going to be under pressure, and any kind of ETF, which looks at, let's say, sort of Vietnam, sort of the Kospi, something like, Korea also heavily hit, is not going to be doing well, but especially something like Vietnam is going to be very, very hit. So I think emerging markets should remain under quite a lot of pressure. In the bond space, no surprise here. We just look at a few. We see the French bonds up, not up. We see the BTPs, the Italian bonds up, just giving back a little bit. We see the Bund up a little bit as well. And then in the US, of course, giving back a little bit, but up overnight quite a lot on the front end of the curve. We see the ZN, the 10-year up, now giving it back a little bit. And what's going to be very, very interesting here, and brings me to my next point, and hopefully the final point is we have Jerome Powell speaking on Friday. And what's going to be very, very interesting here is this sort of counterbalance because Will Powell, they have a mandate to keep full employment. They have a mandate to keep inflation low. So he's at the moment been basically sort of saying, well, we know we don't really need to cut because the employment situation is okay, the real economy is okay, and we still have sticky inflation. But what is quite interesting, if we just look at the reaction, I want to show you guys where we're at with the inflation swaps, which is where the market, prices in what the market-based expectation is of inflation. And what you can see here, this is a daily chart. So what we have here is all the different tenors or durations. So the white one is the 1 year, and the 2 year is the blue one. So what you can see is that this had been sort of relatively stable around about 2.3, 2.4, 2.5%. But ever since basically the beginning of the year, January or so, you can see the 1 year forward inflation swap has really accelerated, and then it's really started to skyrocket, and now it's 3.7%. So what's interesting, so really ripping very, very hard, and that's the daily chart. But if we actually put that, let's say, on a 15-minute chart, hopefully it'll give you a little bit of perspective here. It's not the most perfect chart, doesn't update every second, but we can get a sense here. Again, 15-minute chart for the 1 year forward inflation. This is the market-based expectations for inflation. You can see here yesterday afternoon ripping higher, and that's been on an upward trend, but ripping very, very much higher over the last kind of 12 hours or so. So what's interesting here is that if you start looking at the situation from the point of the Fed, and what I've got here is the Fed funds rate, which is the top one, the white one, which they cut a little bit and then it's been on hold, as you know. And what we have in this sort of orange line underneath is the what I just showed you, which is the 1 year forward inflation swap. And what we can see is that the inflation sort of swaps have been going up since the end of last year. And then now really starting to rip a lot higher. And what that means, if you look at the differential here, is that technically the Fed is actually becoming less restrictive. So remember that when the Fed funds rate, let's say when it was up here, is a lot higher than the perceived rate of the future rate of inflation. The Fed funds rate was, the effective Fed funds rate at the high here was about 3.6%. So 3.6% of which is very restrictive. So that's the Fed funds rate above where the market thinks inflation is going to be 1 year out, right? So that's what it's saying. So this is very restrictive. And just to give a bit of perspective, you go back just after COVID, and we have the direct opposite, where the Fed funds rate was basically at zero and inflation was going crazy up to 6%. And then you have a Fed funds rate, which was actually minus 6%. So incredibly accommodative, very, very easy monetary policy. And then what we had the Fed hiking, and then of course inflation came down. And so what you see is that there was an equilibrium point, and then the Fed became more and more restrictive, reaching a high, as I say, of about September. But the point is here, guys, is that as the Fed, if inflation expectations keep on going up, one could argue, at least from a theoretical point of view, that the Fed is less restrictive. So the question now is, does the Fed hike, or does the Fed definitely absolutely sort of stay on hold and say, no, we know that there could be a potential hit to unemployment and the real economy, but just looking at this situation, inflation is still an issue. So it's going to be very, very interesting. We have Powell on Friday. Let me just quickly check the details for you. So I'm just going to look what Powell's up to. We have central banks. So we have Powell speaking on Friday, my birthday, 4th of April. at 11:25. So 11:25 in the morning on the economic outlook. Very, very, very important speech. Absolutely need to be tuning in for that, because the issue here is really, as I say, does Powell sort of say, well, obviously there could be some sort of hit to economic growth, a GDP forecast, et cetera, et cetera. Maybe the unemployment rate could go up. But the question is, will Powell say, on the other hand, we have inflation expectations also going up? So just looking here, let's say, for example, if we look at what's priced in by the end of the year, so the meeting on December the 10th, 3.2%. Sorry, 3.2 cuts. So the market has gone up now, pricing in 81 basis points of cuts. So the market reaction, very, very interesting. If we look at the market reaction, let's have a look here. Yeah, so if you look, this is a tick chart, so very, very short term. So if you look at the market reaction, initially what happened is, when Trump started speaking, is that the market went from about 70 basis points of cuts, so less than three, until, at about 6:30 p.m. last night, went down to about 90 basis points, so about, 3.5 cuts. And now it's giving it back a little bit, just kind of equilibrium. So I think the market is really going to have to make some important decisions, and this could be affected a little bit by what Powell says on Friday, obviously, and also just what happens over the next 2, 3, 4, 5, 6, 7, 8 days. Like, how do other countries react? Do other countries sort of say nothing and just sort of get on with life and try and negotiate? Do they retaliate in a sort of conciliatory kind of manner, or do they retaliate in a very aggressive manner? Do the Chinese authorities weaken the renminbi to try and sort of balance that up? So a lot of moving parts here. And let's just keep an eye on that, because, as I say, the Fed is in a very, very difficult situation here, that inflation expectations are going up. And what I've been reading, a lot of people are saying that if you look at let's say growth, these tariffs to US growth could be 1.5% less in GDP, excuse me, but could put 50 or 100 basis points on the core PCE. So we could have like a stagflationary kind of environment coming to us, which is not good at all. Okay, so just to wrap up here, guys, a lot of moving parts, as I said. Let's have a look. We are getting some data, but of course, data now, you've got to say, is going to be looking backwards. And after Trump's announcement, I don't know how much validity the market will look at it, but the market definitely will be looking at going forward for any signs about inflation and a slowdown in growth. But anyway, we do have the Challenger job cuts number. Actually, that's come out, because I'm recording this 7:55, so that's just come out 204. So that looks like it's worse. I'm going to have to double check that. Yeah, here we go. So US Challenger March job cuts jumped to highest since May 20. So is this the beginning of a slowdown in the employment? So you see here, it was at 103. It's come to 204. So significantly worse in terms of the number of job cuts. So that's not great. Ironically, we're going to get the trade balance this morning, but initial jobless claims. So interesting to see if initial jobless claims, are we going to start seeing that going up to 230, 240, 250,000? Remember that DOGE, the Department of Government Efficiency, has been cutting for a few for quite a few several weeks, couple of months. And so, at what point will they start to show up? So let's keep an eye out on that. Just quickly, want to have a quick look here. ECB account, both a rate cut and a pause are on table for April for the ECB. Again, the ECB, they seem to have less of an inflation problem, and this could be sort of a hit to the ECB economy and global growth, as I've been saying. So be interesting to see if the ECB actually goes ahead with a cut. That to me seems to be a bit more plausible and logical at this point, but we'll see. What else? Putin. Yeah, Germany and France push for a more aggressive tariff response, etc. Okay, I might leave it there, guys. Get on, have a look at things. So yeah, let's just see how everyone retaliates. Countries retaliate. Specifically, be looking what Powell says on Friday. Let's see as well if just commentary from various global leaders, and especially China, going to be very, very important to see how they react to this. Okay, thanks very much. Have a great day.